Hello dear algorithms traders, now that futures have also slipped into BaFin's focus, we will have to reckon with significant regulations in this area in the coming months. For this reason, today we will compare the already regulated Forex market with the future regulated futures market. In recent years, trading coaches have sprung up like mushrooms, literally ripping off their clients with their unnecessary volume of trading. In addition, they have dubbed the futures markets as the only true markets because the exchanges are said to be fair and honest with their customers. The Forex market, including brokers, has been presented as a scam market that brings massive disadvantages to a trader. The fact that BaFin is now also intervening in the futures markets clearly shows that a lot was wrong there in particular. Massive regulations will follow in order to relieve customers of future obligations to make additional payments. First of all, many trading coaches have gotten cold feet and are understandably worried about their houses, sports cars, and regular income. Have these trading coaches miscalculated because they may have backed the wrong horse? I mean, you can't spend years bad-mouthing the Forex market and then suddenly change horses mid-race. That would question the credibility of these self-appointed coaches. Of course, there are already various German future brokers who, together with their trading coaches, want to calm the heated spirits and promise you a future solution. That way, don't worry, you will be able to continue trading futures with them in the future. The question is always at what price? On average, the round turn of the Euro FX in the futures market in Germany costs $8.19. With American brokers, on the other hand, it is only $4.26, so it is understandable that many traders have gone abroad. In Germany, you pay $8,190 for 1,000 trades in Euro FX. Plus a data feed from CQG totals $8,694. That's $8.69 per trade or €6.96 in costs per 100,000 euro contract. In the Forex market, this corresponds to a spread of 0.7 pip. If the brokers take on the obligation to make additional payments in the future, the costs will inevitably increase in the future. However, we will only find out how the fee increase will affect it in a few months. The fact is that it is significantly cheaper in America, but in the future you will only be able to trade there as a professional futures trader. In Germany, we have to expect further higher exchange fees. The margin will be increased from $440 to $4,166, and at the same time, the leverage will be reduced to 30. In total, the round turn could even cost up to €10. Now let's compare the costs for a scaper who trades 10 times a day with a 58% win rate. So far, he has earned €13,069 through an American broker. The monthly return was 1.1% and the risk per trade was 0.76%. With a German broker, the same scalper only earned €6,730 due to the significantly higher costs. This reduces the monthly return to 0.6% and at the same time increases his risk. If the cost actually increases to $10 per round turn, the profit is reduced to $377. The return is zero and at the same time the risk per trade increases, although he has completed the same trades as before. But at least the broker earns €25,000, which he can partly pass on to the trading coach. So a fair deal for everyone. Even if the costs only increase to €8 or €9, that is still a massive difference to the American brokers. Of course, as a professional futures trader you would have significantly lower costs in the future, but the risk of the obligation to make additional payments is still there. The yield of the Forex trader is a little lower, but there is no obligation to make additional payments. Even with costs of €9 per round turn, the future futures trader in Germany receives €8,000 less profit, thus a significantly lower return and at the same time a higher risk. In total, he pays €10,000 more fees to his broker than in the Forex market. And even with a black swan, he has 10 times the risk because he is liable with his account balance. This means that the Forex trader clearly decides the point of costs for himself. In order to trade one lot in the Forex market, as little as €500 is enough. Due to the regulation of the BaFin, there must be at least €5,000 in the account in the future market. Another decisive advantage is that in the Forex market you can trade with as little as 0.01 lot, while in the futures market the minimum stake in EuroFX is 0.1 lot. This automatically multiplies the losses tenfold. While a futures broker forwards the orders directly to the stock exchange, different Forex brokers still have different liquidity providers in between. This often leads to significantly faster execution in highly volatile phases, especially in the Forex market. Another benefit of the Forex market is the internal volatility within the candlestick. 2 ticks in the futures market correspond to 10 ticks in the Forex market. The movement is 5 to 10 times as high, and there is significantly more information within a Forex candle. This is a clear advantage for the Bionic Candle I developed. This means that the Forex trader clearly decides the point of the broker for himself. The trading coaches often tell absolute nonsense, such as the futures market is the largest market in the world. In fact, the Forex market is 20 times larger than the world's futures and stock markets. Even the Eurist in the Forex market is 6 times larger than the world stock markets combined. Another silly argument is the claim that only professionals trade in the futures market. The 100 largest big players trade in Eurist an average of $20 billion a day, with the largest even reaching $100 billion. $40 billion is traded daily in the S&P future. What should such a big player do now who is supposed to trade the S&P future 2.5 times alone? Believe me, because of the cost, no big player would ever trade in the futures market. Many coaches recommend trading the S&P even though there is evidence that there is significantly less liquidity relative to volume than many currency pairs. When the average number of market orders is greater than the average number of limit orders, volatility increases and the spread increases at the same time. This often creates larger gaps between best ask and best bid and thus increases your costs disproportionately. This reduces your income and at the same time increases the risk. Another silly statement: the stock market is fairer. First of all, the stock exchanges are profit-oriented, while the foreign exchange market was created so that banks could exchange money among themselves at low cost. Of course, the brokers also earn money from us, but the big players pay 100 times less fees in the foreign exchange market than on the stock exchange. The exchanges set rules that everyone who trades has to accept beforehand. We know that exchanges give priority to certain big players in the queue. This leads to the conclusion that their orders are always as close to price execution as possible. In trading, the rules are set by exchanges in the form of matching algorithms and sometimes different latency priorities. These rules can favor certain types of market participants, such as registered market makers, by offering them higher matching priorities or even adding artificial speed thresholds for other traders. These rules that the exchanges have set up can be considered fair because they are public. This means that as a futures trader you have to know that you are disadvantaged on the stock market. If you still trade and lose, it is your own fault because you previously accepted the rules of the game. Another disadvantage in the futures market are the so-called high-frequency traders, who inconveniently increase the retailers' prices. There is no such thing as high-frequency trading in the Forex market, as artificial time blocks have been introduced that high-frequency traders avoid like the devil avoids holy water. This means that the Forex trader also has a clear advantage over the futures market in the market area. Since 1984, the World Cup Trading Championships has held a World Trader Championship every year. On the left side you can see a table where the respective world champions are listed in the individual categories. The average return across all categories is 190% per year. It should be clear to everyone that such a return can only be achieved with an increased willingness to take risks in trading. In the equities sector, an average performance of 81% per year was achieved within 11 years, in the Forex sector 106% per year, and in the futures sector 308% per year. In addition to further information from the banking and broker market, this results in the losers and winners. And this is exactly where the futures market is ahead for the first time. And of course that has primarily to do with the fact that you have a much deeper insight into the futures market than in the Forex market. However, you need special software and appropriate filter settings for this. We can clearly see here that the futures market is way ahead of the Forex market when it comes to data. Then, however, there are a few extras that are withheld from the futures market. An example, virtual stops that the broker cannot see. This means that a retail trader is also able to hide his stops. Likewise, there is no currency strength in the futures market, which however provides very important information for a trader. Theoretically, this would also be possible for the futures market, but only with extreme effort. As you know, many years ago I developed the Bionic Candle, which follows the institutional approach of the big players and shows their invisible price zones. If we compare the Bionic Candle in the futures and Forex markets, it is noticeable that the Forex market forms clearer price structures. This is because the Forex market achieves significantly higher volatility within the candlesticks. In terms of extras, the Forex market is clearly ahead of the futures market. Overall, the regulated Forex market thus achieves 260 points and the future regulated futures market only 170 points. So it is initially 4:2 in favor of the already regulated Forex market. But is that really enough to be successful with only Forex data? With the same profit rate of 58%, you can make a profit of almost €11,000 in the Forex market and only €2,500 in the futures market. Now the trading coaches will argue that you have significantly higher profit quotas in the futures market because more in-depth data is available there. I have to agree with the coaches unreservedly, but this fact is still no reason to invest your money in the expensive, regulated futures market. Because as you know, I have been working as a hybrid trader for many years. That means I only invest my money in the Forex market because it is much safer and I make my trading decisions from the futures market because there is much better data available there. And if I now use this stock exchange data for trading in the Forex market, our comparison data will of course also change. This gives the hybrid trader a much greater advantage than if he were only trading in the Forex or futures market. As we know, a trader needs a lot of losses in the beginning to train his negative emotions. After about 10,000 trades he is able to break even. And now comes the question, in order to break even, do you want to accept a loss of €6,000 or would you rather just lose €550? And if you really want to make less loss, you should give the futures market a wide berth. Basically, every trader should ask himself where he can achieve the most return with the lowest risk and at the same time keep the money he has won with a high probability. Of course, you can also award individual points for the Forex or futures market to find out which is the better market for you. There are many advantages of being a hybrid trader when I trade the Forex market and at the same time use stock market data from the futures market to make trading decisions. In contrast to the trading coaches, I don't denigrate any market, on the contrary I simply use the strengths of each market to my personal advantage. And that's exactly what every trader should do to increase their personal probability of winning. And I wish you the best of luck with that. Best regards, Michael.